it's very important to remember debits and credits. And remember something about debits and credits? They do not mean left and right. They do not, see? Now you got me all confused. They do not mean increase and decrease. They simply mean left and right. Okay? And we said that assets, expenses, and dividends, those are accounts that have normal debit balance. What do we mean by that? An increase to those accounts will be added to the debit side. A decrease will go on the left side. Right? Right?
Yes.
On the other hand, credit balance accounts, they are like liabilities, stockholders' equity, retained earnings, revenues. Okay? So we're good. Today we're going to talk about the next step. We're going to talk about adjusting entries. And why is that important? So we prepared the trial balance last week. We learned how to prepare the trial balance. And is it enough? What's the main issue with the trial balance? Yes. Okay, so you may enter you may make a certain entry that where the wrong entry and still have the trial balance basically checked. Okay, what's the problem with the trial balance even if there were no mistakes? Yes. Okay, so you are on the right track. What you're saying is that basically, what about accounts receivable? What will happen if we receive them later on? How do we fix that? And this is actually a true thing. The problem with the trial balance is that its information most of the time is outdated. Right? Do you remember the example with the insurance policy? Do you still remember that one? Yes, no, maybe. Okay, so this is where the company purchased a 1-year insurance policy at the beginning of, let's say, September. This is a 1-year policy, right? Let's say that the company purchased that policy on September 5th. By the end of the month, where does it show? What does it show on the balance? That the company still have, according to the trial balance, the balance for insurance, for the insurance policy, for the prepaid insurance will still be for 1 year, right? But is it true still for 1 year? 1 month has already passed, has expired. Let's take the example of supplies. We bought 100 pencils. And according to the trial balance, the company made a purchase of 100 pencils. Each one is $1, so it's $100. The value of those, of our supplies, is $100. Everyone's okay with that, right? That purchase was made on, let's say, September 10th. What would the trial balance on September 30th show? $100, right? This is what happened last time. But what about the 20 pencils that we used in this month? This is where it's important to, this is why it's important to do what we call the adjusting entries. You see the issue here now. And what's the problem? You see, this is where the problem of the time periods, this is where companies started to do this, adjusting entries, etc. And the thing is that, the main issue is that companies, if we were to wait until the end of time, until the company ends, we could easily calculate all the expenses and all the revenues of that company, right? I mean, you would have it in numbers in front of you. You made such and such sales, and you have those expenses, period. What's the problem with this? Can you wait until the end of the company's life? Let's say that you're an investor. Wouldn't you want to know how the company is doing? Now, basically, periodically, every year, every couple of months, etc. What about the IRS, for example? Taxes. Are they going to wait until the company stops, basically, bless you, after the company actually goes either bankrupt or basically stops to exist to make them pay taxes? They want to receive their taxes every year. This is why accountants came up with this idea of time period assumptions. So they break the life of the company, which, as you can remember, it has most of the time has like an indefinite lifetime until it goes bankrupt or if it's purchased by someone else and dissolved, something like that, liquidated. However, generally speaking, you have the company is expected to live for years and years. So what do? They break it down into artificial time periods, into a month, a quarter, a year. That depends on what the company or how the company is, how often the company would like to see those reports. So management, for example, can they wait until the end of, basically until the end of the year, even until the end of the year, to know whether a certain product or a certain location is causing them to lose money? Can they wait until that time? Or do they need to react more, basically faster, in a more timelier way? What do you think? Can they wait? Does the management wait until the end of the year or even a quarter to react to a certain transaction? When this happens, company CEO or CFO most likely will be fired. Because at that time it will be too late to react. There was a company, I can't remember the name of that company, within like 45 minutes or something like that, they lost like $400 million. It was a stock, basically, that company was a dressing company and they were dealing with that, and there was a glitch in the system. They updated their system, and there was a small glitch that they forgot to remove, which was basically to stop from buying and selling the stock. One line of code. Any one of you who did any programming would know that it's just one line. Let's call it loop. It brings it continues to do the same thing. And within a few minutes, they made thousands and millions of buy and sell stocks. What happened at that time? They lost by that time they lost hundreds of millions of dollars. A company like that cannot wait until the end of the month to react. They have to react immediately. Other companies, even like Apple, yes?
So do larger companies then favor shorter accounting periods or longer? Or does it depend on the size?
It depends on the size, it depends on the type of company. So for example, that companies that deal with the stock market, they need to know about stuff within the minute, if not the second. This is why there are certain companies that deal with something. Has any one of you heard of continuous auditing and continuous control monitoring? Except Cecilia, she probably heard that. Yes. Well, Rutgers is one of the top schools and top organizations in the country, if not in the world, who deal with what we call continuous auditing and continuous control monitoring. I know that I'm digressing a little bit here, but I think that's important to know. There are certain companies, like for example Siemens. What they do is they have what we call continuous control monitoring on a daily basis. They are actually capable of identifying any problems, any errors, any mistakes in certain areas of their business. For companies like Siemens, especially the financial side of it, they want to know that on a daily basis. So it's not monthly or quarterly. They want daily reports. They get that. They use sophisticated software, etc. The reason why I said Rutgers is one of the top schools in doing that, actually my dissertation is related to this kind of work. We have a research center that's called the Continuous Auditing and Reporting Lab. Here we don't believe in just doing it every year or every quarter. It has to be done basically, or it should be done on a more continuous basis. So to answer your question. So it depends on each company and their capability. You have big companies cannot afford to wait months to get their reports. The management would want to have the information almost immediately. So companies basically they have, generally speaking, and now we go back to the traditional way of accounting and auditing, not the continuous type of it. Now, companies they have monthly reports, they have quarterly reports, they have yearly reports. So they split it in that. Now, if the transaction happens within the same month, that's easy. Why? Because at that time, it can be done within the same period. The problem mostly will mostly happen when it extends over 2 or more accounting periods. So for example, the company, you remember the supplies when we talked about the supplies, right? We said that the company we had 100 pencils, we used 20 pencils. So this purchase of supplies in the month of September, is it going to be used only in the month of September, or is it going to be used in September and October and November? Come on, wake up. I answered your questions. It's only fair that you answer my questions when I ask them. So now it's your question. It falls on your head. You have to answer it. So those pencils that the company purchased in September, we said that there were 100 pencils, right? We used 20 of them in September. What about the 80, the remaining 80? Was that purchase used only in October, or did it extend to other accounting periods? It extended to other accounting periods, right? It was also used in October. It will also be used in November to generate revenues. As a result, is it fair to say that this expense, this supplies expense, was fully, or was to be considered as if it were expenses for the month of September, or do we have to split that cost over the different periods where they were used? Which one is more representative or is fair to do? We have to split that cost. This is the problem. It's when it is after one accounting period or 2 accounting periods. It's not when not the whole thing happens now. If you provide a service, remember the unearned revenues and the prepaid insurance, for example? Let's say, for example, the company now provides a service now, and they get paid now. What's the journal entry? Cash, we debit cash, we credit service revenue. The company earned revenue now, that's easy. It gets more complicated when you have a service that you provided part of it now. Can I give an example of this? Come on, think of an example where a company can give you part of the services. Yes? A construction company. Let's say that the company had, you struck a deal with the company that they will build you 2 buildings. When are you going to pay? Well, although let's say that this is a small amount of money, but they say that they are going to send you the bill once the whole job is done, right? What if you finished 1 building? You partially finished that obligation, right? Did you finish the whole thing? No. So you're not going to get paid. However, did you earn any of that money? Yes. I'll give you another example. Let's say that you are an advertising company and you had a client who requested 3 billboards. Are we all okay with that? Happens pretty often. So you have to do it in 3 billboards. You did 1 of them this month. The company, as far as they are concerned, they will not receive the bill, they cannot send the bill to the client until the whole service has been provided. But the company didn't earn that money. So this money that was earned will go beyond this month. It will go beyond this accounting period. This is why it's important to do those adjusting entries. The adjusting entry will adjust for the 1 billboard that the company already provided. It will say that, okay, while we still did not receive cash, we cannot send them the bill because we haven't finished the whole obligation, but we did part of it. And for that part, we earned the money and we will make the adjustment in our trial balance. Okay, so like when we talk about a year, we're talking about the fiscal year. Most companies, many companies, they actually have the fiscal year, it coincides with calendar year, basically from January 1st until December 31st. But a lot of companies actually, they have different fiscal years that, for example, starts from July until end of June. So it doesn't have to be exactly that. Some companies will have, for example, the first Friday of every November, something like that. But basically, fiscal year is 1 year. Quarterly and monthly accounting periods, this is what we call usually interim periods. Because most companies, all companies, they have to provide, all publicly traded companies, they provide those yearly financial reports, the annual reports. They also provide quarterly reports. Monthly reports are not usually published or anything like that. Most of the time they are used for internal purposes and so on. Any questions? So, let's do this one. Okay, so it is actually, this is the majority of the class got it right. Time period assumption, it talks about splitting the economic life of the company. Now, there are two ways to look at revenues and expenses as such. We have accrual basis accounting and cash basis accounting. Accrual basis accounting, it talks about, this is where the company is expected to recognize, for example, revenues when the company has provided the service or made the sale. Okay? And to recognize the expenses when they are incurred. Basically, when they are used to generate those revenues. So they associate expenses with revenues. You're looking here at an accrual basis accounting, looks at the event in the time period that it occurs. The company provided the service. You remember the 3 billboards? The first billboard was completed in September. When did that event happen? When did that event happen? Again, I can't hear you. Yes. September. So when will the company recognize that revenue? September. What about the cost of employees who actually put that billboard up there? The cost or the salaries of those employees and the cost associated with that billboard will be recognized in September again. This is when the event happened. Cash basis, it's much simpler. When you talk about cash basis accounting, revenues are recognized when the company receives cash. Expenses are recognized when the company pays the cash. So when you receive cash, that's a revenue. When you pay cash, that's an expense. But there's a problem with cash basis accounting. The main problem with cash basis accounting is that it does not take into consideration all the sales and all the services, etc., that were done on account, and the purchases that were done on account. Now, when you think about it, small companies, they actually, small and proprietorships, etc., they most of the time they just stick to cash basis accounting because, like a hair salon, do you expect them to have a lot of accounts receivable? Are they going to cut someone's hair and collect the money 2 months later? Hey, pay them cash. And by the way, cash, credit card, checks are considered cash because this is money that goes directly into your bank account. Well, difference like with credit cards, you might have to pay a certain fee, etc. But basically, what you're doing here is you're receiving cash. Accounts receivable is a credit where the company will allow you to pay 2 months later or a month later or something like that. So those small companies, it makes sense to them to use cash basis accounting. what about companies who deal with a lot of accounts receivable? What about a company like, say, UPS or FedEx? They buy a truck that will be used for 10 years. According to cash basis accounting, if they buy the truck now, this is the cost of this year. So let's say that in 2015, so what happens is that in 2015, the company buys a truck for, let's say, $30,000. According to cash basis, company will say that, okay, in 2015, the company paid $30,000 for the truck. And then they made revenues for $10,000. So what's happened as net income or net loss for the first year? Okay? So for example, in 2015, company bought truck for $30,000. They made revenues $10,000. Did they make money or lose money? They used the same truck in 2016. So they didn't buy any additional trucks. They are using the same truck. Do they have any expenses? So zero expenses. What about the revenues? They also made $10,000. If you look at those numbers, they are misleading. Because in this case, you look at it and say, okay, so the first year the company lost $20,000. The next year, the company made $10,000. So if you follow that logic, you expect in 2017 to have how much? Again, this is zero. You expect the net income here to be $30,000, right? Because here you had, oops, sorry. Here we had minus 20. Here we had plus 10. So it increased by $30,000. You expect here also to increase by $30,000. So you expect it to be like $40,000 net income. But is this normal? Does this make sense? Is it true? That's not true. That's misleading. That's why, according to US GAAP, companies are not allowed to use cash basis accounting. Companies are required to use accrual basis accounting. All publicly traded companies, they are required to use accrual basis accounting. This is where they actually they recognize the revenue when the service is provided or the sale is made. And they recognize expenses when they are incurred. Okay? Any questions? So you can see why cash basis accounting can be more or less can be appealing to certain companies because it's simple to use. However, it creates all these issues related to, for example, accounts receivable. And let's say that the company makes a lot of sales on accounts, okay? On account. All this will not be included. So according to accrual basis accounting, revenues are recognized when the service is provided. Basically, when they are earned. Okay? When does Best Buy earn the sales of basically the money from a TV sale? When they actually deliver that product. So this is called the revenue recognition principle. Very closely related is the expense recognition principle. Sometimes they also call it the matching principle. Why is that? Because companies are expected to match expenses with the revenues that were generated in the same period as those expenses. Right? Because, for example, they will have to match the utilities and basically the cost of maintenance of this room with the tuition fees that they received from you for this same class. You understand now? So for example, again, let's go back to the truck. The truck was used, let's say, for 10 years. And at that time, the maintenance associated with the first year should also be included as an expense for that year. oil change, for example. Going back to the billboard example, the company earned the money from that billboard, right? The matching principle and the expense recognition principle, what does it mean? It simply means that the salaries of the employees who actually put that billboard up there and the cost of the material that was used to do that, those are the expenses associated with the revenue that the company received from putting that billboard up there. You match the expenses with the revenues. That's not very easy, but there are rules and guidelines on how to do that. This is what we will be learning mostly in this course. Okay? So this slide here just shows basically what we learned here. We have the time period assumption. Because of the time period assumption, this will affect the time certain revenue or expense are recognized. So it affects revenue recognition. Expenses, they follow revenues. It's the matching principle, and all this will lead to the revenue and expense recognition under GAAP, which uses accrual basis accounting. Any questions? Now, this is very important here because have you guys heard of cooking the books? But here, the idea is that cooking the books, it means that when the companies, all companies, they try to meet a certain expectation. This is what we call analyst forecasts. So for example, there are financial analysts who follow each company. They say that, for example, based on previous years, etc., we expect Samsung this year to make $70 billion in revenues. However, what happens if Samsung makes only $50 billion or $60 billion? Their stock price will go down. It's always affected negatively in that case. This is why companies try to do what we call, they try to meet or beat financial analyst forecasts. Because at that time, if they already got to the point where for example, they made the same revenues that was expected, then that means that the company is doing well. Okay? That they didn't have any issues this year. Or if they had any issues, they were able to overcome those problems and to make the same revenue. So, but let's say at the end of the year, Samsung, they only made 60 or 65 billion. They are like $5 billion short of revenues, or $10 million short of revenues. One way to do it is to have huge promotions in December. Let's say that the fiscal year ends in December. What will happen? They will have huge sales, even at loss. What will happen to their products, their revenues? They will increase, but is this actually to the benefit of the company? Now this is okay if the company is doing that just as a promotion. What happens is that certain companies, certain companies, they would do is they would make those sales and then allow, for example, Samsung would sell a large number of TVs, for example, to Best Buy. And then in January they will return them. Now, this is a little bit more problematic, right? What happens as far as anyone looks? Is that a movie? In certain cases, companies will try to increase their sales in so many ways at the end of the year to improve their numbers right before year end. But on the long run, this will hurt the company. Okay? I'll give you another example. Let's say that now, Dell, they are not doing so well in the sales, and this is just an example, and as a result, they may not meet analyst forecasts for this year. What can they do? They can start a promotion, for example, where anyone can get a laptop on credit, 0 interest, no credit check required. What will happen? This year, you have, every one of us would go get a computer like that. Makes sense. So they have this huge, like a lot of people who are buying those computers at very discounted prices, no interest, no check required, etc. What happens is that their numbers will increase for now. But next year, a lot of people may not pay back the money. They will default on that payment. What happens to Dell at that point? They will lose the money. So basically what they are doing is they are taking the money from next year and recognizing it now. All these things are not allowed. Okay? Here, for example, I don't know if you read this before, but you know, for example, like donut shops, etc., Krispy Kreme, they can actually sell the products and then they can take them back. So they can sell huge amounts in December, take them back in January. That will bring up their sales, but all this will be a loss that will be added or postponed until next year. This is actually one of the reasons why I do my research in the way I do it, because like in Rutgers, we do this kind of research to identify such events. Any suspicious transactions, etc., can be easily captured. Not easy, actually, it's not that easy, but it can be captured using this kind of research. If anyone is interested in talking more about that, please be my guest, just come over here and I'll talk about it later on after class. Okay, so which one is false? The answer is D. This is the cash basis. When you talk about it, this is the cash basis. Right? It's when revenues are recorded only when cash is received. This was problem. So NAB company had the following transactions during 2014. Sales of $9,000 on account. Collected $4,000 for services to be performed in 2015. Paid $1,250. Cash and salaries and purchased airline tickets for $500 in December for a trip to take place in 2015. What's the net income? Using accrual accounting. So what do we need to do here? We need to recognize it. Basically here, Bhavna, right? Okay, I hope that I didn't butcher your name this time again. So here, what you have to recognize are actually is it from the ceiling? What?
It's below us.
Seriously? Okay, see you guys, and see you next week. Anyways, I'm here, I'm close to the door. I feel bad for you guys. So basically what you have here is, you have to look at the revenues that were done, that were earned in this same year, in 2015, and that you have to also look at the expenses that were incurred in 2014. Okay? So in the first one, sale of $9,000 on account. Did the company make those sales? Then yes, you include it. So we have $9,000. Plus, collected $4,000 for services to be performed in 2015. Did the company earn that? Now the company did receive the cash. But that would be what kind of accounts involved? Yes, sorry? Who's saying? No, someone. Jason, you said that? Who said that? Okay, so why are you hiding? Yes, you're correct. Unearned service revenue and cash. The company received them, but they haven't earned the money yet. So this one, we will not include it. Paid $1,250 cash and salaries. Yes, you will include it. Right? So this is minus here. $1,250. Purchase airline tickets for $500. So the company did pay the money. Did the company use that resource? Now they have airline tickets. Did they use them? No, they did not. As a result, this will not be included. This is prepaid airline tickets, right? It's an asset. It's not a revenue. Remember, when you calculate net income or net loss, you only look at revenues minus expenses. Period. Not unearned revenues, not prepaid expenses, but it's only those two. Any questions about this? Okay. Yes?
What if they never use an airplane ticket? They're gonna show or
If they expire, for example, etc., that will be some kind of an asset that was lost, but we will learn how to deal with that later on. At this stage here, you don't do that. You have in certain cases where the money basically you have write-off of inventory, etc., not now. You have plenty of that later on. So those are a list of concepts. When you talk about accrual basis, take a minute to, or a few seconds to actually look at these and tell me which ones do you think they would base match them. Okay, so the first one, accrual basis accounting. Which one do you think is? Yes? F. So, in this case, we have companies, they record transactions in the same period that it occurred, or that event occurred. Calendar year. Yes. E. Yes. Time period assumption. Yes?
C.
C. And expense recognition principle. Yes? Lauren? E. Okay? Some of them are closely related, so just need that if you got one mixed up, etc., so that's fine. Just you have to understand the concepts. We get to adjusting entries. Now remember what we talked about first at the beginning of this lecture, is that we need to make those adjusting entries to the trial balance to update it, right? So if you have a certain balance, for example, supplies balance, it still shows at the beginning the full amount of supplies, while you use some of it during this month, then you have to actually adjust, make it an adjusting entry for that. This is actually a necessary step before preparing any financial statement. You must have updated balances. Okay? Most of the time when an adjustment happens, you include one income statement account and one balance sheet account. What do we mean by that? Do you remember what are the income statement accounts? Come on. What are the income statement accounts? Yes. Yes, but what are the accounts? So we have, what kind of accounts we have? Jason? Revenues and expenses. What about balance sheet accounts? What are the balance sheet accounts? Yes. Assets, liabilities, and stockholders' equity. Okay? Thank you. So those are basically the accounts that will be involved. And why is that? Remember that, for example, when you use part of the expenses, part of the supplies, right? You spent those pencils. So it used to be an asset, right? When you spent the 20 pencils that we use, they become what? An expense, supplies expense. So those $20 supplies expense is what? This is an income statement account. As you can see, it was one asset account and one expense account that were involved in this case. Adjusting entries are made to all of the above. Come on, I mean, you've already done that now, right? So we have two types of adjusting entries. We make adjusting entries for deferrals, adjusting entries for accruals. Deferrals are, what deferrals mean is this is when an event happens after the exchange of cash. So the company either receives cash for a service that they will provide in the future, right? That will be unearned revenue, or the company will be paying in advance for a service that they will receive in the future that will be a prepaid expense. Deferral means postponing of the event. So basically when you defer an event, you are postponing it until a later date. In this case, the money is being exchanged now, but the actual event will happen when the actual service will be provided in the future. The actual sale will happen in the future. Okay? But money, you receive the money first. The actual, basically, not sale, the actual fulfilling of that obligation. And if you remember, we said that, for example, for company A, when company A has a prepaid expense, company B will be the other way around. It will be unearned revenue to them. It's like, for example, if you pay, it's like when you pay Rutgers, right? You have a prepaid expense, which will later on be, it's a prepaid tuition. Rutgers, they have unearned revenue. Okay? Any questions? So that's the first part. This is when the money is exchanged in advance. The other one, it counts for accruals. This is the accrual means accumulation. This is the work. You remember when I said that, God forbid, if Rutgers decide to fire me, I can't even say the word, but if they decide to fire me, they will still owe me the money that accumulated from the last paycheck until today. This money has accumulated. Let's say I get my next paycheck on September 27th, right? I will still be working for 2 days, depending on the weekend. I can't even remember what it is. Let's say that I still will be still working for 3 days. Will they pay me that money in September? It will be paid in the next paycheck, which will happen in I'll keep saying in until someone says the month. In October. Thank you. See, that wasn't hard. So, I mean, you don't want me to also get paid next year, right? You want to get paid at least in October. So in this case, this paycheck will include 3 days from September. But at the end of the month, Rutgers will have to recognize that liability. Now they owe me 3 days because I provided them with the service when? In September. So the expense of paying me my salary for those 3 days will have to match the revenue or the whatever they received. That was my service as an awesome professor. What about, hey, come on, not even that. Thank you so much. Thank you. See? Now I'm happy. See? That's cheating, but still, I don't care. It's not an exam. See? Doesn't work now. Okay, not my fault, it's working. Anyways, so basically this is what's happened. We have accruals, and we have 2 types of accruals. We have accrued revenues. This is whatever the company, remember the 3 billboards? The company did not fulfill the whole obligation of 3 billboards, but they did 1 of them. So they had accrued revenue. They got 1 revenue that they will not be paid for, but they have to recognize that revenue. Accrued expenses is, for example, when Rutgers has to actually recognize their debt for the 3 days that I will be working in September without getting paid in September. Any questions about that? You guys understand the difference between the 2 now? Okay? So here we have trial balance. That's the original trial balance. Remember that the information here is not updated. it's not up to date. As a result, we need to update that information. So we'll start with deferrals, okay? This is whatever the company is going to receive cash in advance or pay cash in advance, or either revenue that will, service that will be provided by them or service that they will receive. Okay? We talked about those two, by the way, last week. Can anyone remember what were the examples that we used last week? Yes. Insurance. So for the prepaid expenses, we had prepaid insurance. What about unearned revenue? Did you have any of this? Remember when the company received cash in advance for services that they were supposed to provide a couple of months later? Okay? There are different examples here. When you think of prepayments, etc., this is, for example, if you buy season tickets. And just to let you know from now, I suck at sports. So if I say something that doesn't make sense, please, and very gently and politely, let me know and don't make me look like a fool. Okay? So basically, if you buy season tickets, you buy, let's say, that 5 season tickets, okay? For $500. So for each, as far as you're concerned, you have assets, prepaid tickets, with the value of $500. Have you used them yet? Have you attended any of those games? There are 5 games. This is one of them. So in this case, let's say that you have this amount is as a prepaid expense. After you attend the first one, did you spend one of those tickets? So it was 5 tickets for $100 each. Total was $500, right? Let's say after the first game. So after game 1, how many tickets did you spend? 1 ticket. So you spent 1 ticket. What's the value of this ticket? $100. $100. That would be your expense, right? So let's say that you bought them in September. The first will be in September. So you bought them in September. First game was in September. What's your new asset? The value of the asset. What's the new balance of your asset? Sorry? $400, yes. So we still have the asset, prepaid tickets, and it's still valued at $400. This is what we still have. So what did this adjusting entry do? It told us how much of that asset was used. So it gave us an expense, and at the same time, it also told us how much of our asset we still have, the amount or the value of the remaining assets, which is in this case $400. Do you have any questions about that? Okay. And like I said, there are different examples. So here, for example, you have rent. When you pay rent in advance, when you pay tuition in advance, when you subscribe to a certain magazine in advance, those are all prepaid expenses. Okay? This is when you actually are paying for something before you actually receive it. Now, like I said here, it gives us whatever was used and the amount that is still remaining. So So you need to make a journal entry, an adjusting entry. Okay? The adjusting entry, what do we have here? What happened? So we had before. So on the trial balance, see here, trial balance. What did we have? We had prepaid tickets. How much was it? That was an asset. How much was it? $500. That's in the trial balance before making any adjustments. It was 500. How much was the expense? Sorry? No, before. 0. That was before making the adjustment. You remember the trial balance would reflect the original event. The original event was that you bought 5 tickets. So according to the trial balance, you had as asset $500. You had as expenses 0. After the adjustment, you will have 400 and 100, right? So what do we need to do to adjust to get to this amount? What's the adjustment here? We have to decrease our asset by 100 and increase our expenses by 100. How do you decrease an asset? You credit the asset. So we credit asset. How do you increase an expense? You debit that amount. So basically we're saying that, okay, I had 5 season tickets. I used one of them. So that one is spent. This is it. This is what we're saying. They were valued at $500. I used one ticket which has a value of $100. That $100 is an expense because I used it, and the remaining 400 are still as an asset. So for example here, Pioneer Advertising Agency purchased supplies costing $2,500. On October 5th, Pioneer recorded the purchase by increasing or debiting supplies, and also it shows at the end. So in this case, it shows at the end of the month, it still shows what balance 2,500 for supplies. Because it does not reflect whatever you used during the month of October. We need to make an adjusting entry to adjust for whatever has been used in October. Okay? Usually the way this is done is by doesn't make any sense to make daily adjustments. It's not like every time you use a pencil, you're going to write, okay, so you're going to make a journal entry that, okay, so you took a pencil, right? Do you think that this is efficient for companies to do?
No.
So what they do is, at the end of the month, they will go and they will count whatever supplies they still have. They do the inventory for their supplies. And they see that they still have, for example, 80 pencils. So at that time, how many pencils did they use? We know that they had 100. They still have 80. So how many did they use? 20 pencils. In this case here, this example, the company purchased supplies for 2,500. When they counted whatever supplies they have, when they looked at the supplies that they have, they found that they have supplies for $1,000. What does it mean? How much did they actually use in October? 1,500. So what do we need to do now? We need to decrease. Yes?
So you would credit the assets
Yes.
and you would debit the expenses. So you credit 1,500 for the assets and then debit 1,500 for the expenses.
Exactly. So what we do here, you have to decrease the value of your assets by $1,500, and you need to increase your supplies expense by $1,500, right? As a result, we debit supplies expense $1,500, we credit supplies $1,500. The new balance under supplies will show $1,000. That's correct. This is the actual amount of supplies that you have, and at that time it is not, basically it is faithfully representative. So here, this is how you analyze it. You have the supplies expense is increased, and we need to, basically we have we have more supplies expense, and we have decrease, we have less supplies. Remember this minus here, what does it stand for? A negative effect on stockholders' equity. We have more supplies expense. The minus here does not mean that expenses have decreased. Actually, they have increased. And this is the journal entry. And then we post it. Now the new balance for supplies is $1,000. This is the actual one. This is the one that will show up on the adjusted trial balance. And this is the number that will be used later on for if there are no correcting entries, etc. This is the one that will show up on the balance sheet. Okay? This is the number that will be used for financial statements preparation. On October 4th, Pioneer Advertising Agency paid $600 for 1 year insurance policy. Okay, so in this case, you know that it's for 1 year, $600. So every month it will expire by $50, right? 600 divided by 12. So according to the trial balance, on October 31st, the trial balance will show that the company has $600 in insurance policy. However, the company already used the month of October. How many months do they still have? 11 months, right? So they have an asset, which is prepaid insurance for 11 months. The value of these 11 months is actually $550, not $600. So we have $50 that expired, that were spent. And in this case, what do? We have the asset, prepaid insurance, has decreased, right? And we have a new expense, interest expense, which has increased by 50. So we debit the expense and credit the asset. Any questions? As you can see, this is the same thing as basically the one before. Okay? We debit the expense, we credit the asset. Which is, remember that this type of assets are prepaid expenses. Any questions? Depreciation. This is where some people get confused. Depreciation is not an evaluation of the equipment. You talk about the truck that the company bought for $30,000. They expect it to be in use for 10 years. Okay? This does not mean when the company depreciates the truck, it does not mean that the company is actually looking at the market value or the fair value of that truck. Depreciation is simply splitting up the cost of that asset over what we call the useful life. What's the useful life of a truck that will be used for 10 years? 10 years, right? So you're going to use it for 10 years. The useful life is 10 years. As a result, if you bought it for $30,000, you need to split up the cost over 10 years. Why? Because the truck will be used over these 10 years to generate revenues. So it will be associated with revenues over these 10 years. How do we calculate depreciation exactly? We will learn how to do that in the future, later on. But for now, this is what you need to understand. We are not looking at the market value. What we're looking at is basically the concept of depreciation. Basically what we're doing here is we are allocating the cost that the company paid for certain equipment or a building over the useful life of that building or of that equipment. Okay? So for example, for Pioneer Advertising, we assume that depreciation on equipment is $480 a year, which is to mean it's $40 per month. So every month, the company will have to decrease, right? Will have to consider $40 of the value of that asset to be considered as an expense, right? In the same way. So what do we do? What do we do? Yes.
Credit the asset.
And that's partially correct. Equipment and buildings, etc., they have slightly different thing. What's happened here? What would happen if we actually do that? We would violate the cost principle. Remember that when a company buys an equipment, they have to use the cost to keep recording it at this point. Yes?
So would you debit the asset if you're not going to get the full value of it, so you use it for that 10 years?
No. You bought the asset, that was the purchase of the asset. But at the end of the month, you are going to depreciate the value of the equipment. So in order to avoid doing that, to avoid basically, what's it called? So basically, this is to avoid violating the cost principle. But at the same time, to keep track of how much cost is allocated to that accounting period, companies use accumulated depreciation. So this is a contra asset account. You see it said, okay, so here, what you would think originally, like if we were to use it in the same way that we did with prepaid insurance or with supplies, you would do the same thing like, basically like you mentioned, okay? So you would debit supplies, debit expense, and credit the asset, right? That would actually violate the cost principle because at that time the company will not be recording equipment at that value. So instead, what companies do is they do, okay, so let's leave this one alone, let's not touch it. Let's use an account that is called a contra asset account. And that one is called accumulated depreciation. In this case, you credit accumulated depreciation. Accumulated depreciation is a contra asset. It's basically a negative. It will be basically subtracted from equity. You guys are still confused, right? Let's do this here. What you will be having later on is you will be saying that, okay, my equipment, the value, this is on the balance sheet, okay, and on the adjusted value. Equipment, the value is, let's say, $7,000. Okay? Less accumulated depreciation for the value of $40. What's the actual value of the equipment? What we call the book value of the equipment? It will be 7,000 minus 40. Now this is, it ends up the same way more or less as if we actually credited the asset directly, right? That's the value that we would have if we were to credit the asset. But in this case, this will give us more information. Companies like this because first of all, they can still know how much they pay for every equipment they have. They can keep track of the payments of the equipment purchases. At the same time, they will know how much was used as an expense, how much was allocated as depreciation expense. Okay? You're still confused. Still see that again a little bit soon. But a little bit soon. In a few months. For now, just bear with me. Whenever you have depreciation, don't credit the asset because that would violate the cost principle. Credit accumulated depreciation. Okay? Accumulated depreciation is a credit or it's a contra asset. As a result, it will decrease the assets. An increase in accumulated depreciation will decrease assets. Okay, and this is why when you have accumulated depreciation, it's a credit, has a credit balance. Now this is how it looks on the statement. So on the statement you would have equipment less accumulated depreciation. Think of those two together as one item. As one item. What happens in this case? You are crediting this one item, but it will go directly to this one. Your expense has increased. So what we did was we debited depreciation expense. We credited this here. Okay? No. Okay, we'll talk about that more on Friday.